Morning, everyone. This is the Standard Solutions to Mitigate Mortgage Default and Delinquency. My name is Bianca Santos, and I am the Compliance Officer. So if you guys have any questions, concerns, you can just reach out to me. So our mission statement, so the Pennsylvania Housing Finance Agency, we have diligently pursued its mission to foster community and economic development and making the Commonwealth a better place to live. PHFA provides the capital for decent, safe, and affordable homes and apartments for older adults, persons of modest means, and those persons with special housing needs. PHFA works with housing counseling agencies, local lending institutions, realtors, and other public and private organizations. Through the years, we have gained the experience necessary to be effective in Pennsylvania communities by providing services and programs that expand and protect home ownership and stabilize our urban and rural neighborhoods. So here is our agenda for today. We will go over the training goals. We'll meet the players. We'll also go over all the mortgage loan products. We'll go over the 3-step process, strength-based counseling, the counselor's role, teaching your clients or your clients to know their options, whether they're going to be curable or incurable. We'll go over the PHFA loan servicing department here at PHFA. We'll go over the foreclosure process, the typical mortgage foreclosure scams. We'll touch on bankruptcy, and then we'll end out with some resources. So our training goals are to provide new and existing counselors with an overview and a refresher course in the counseling process. This course will also provide details about the PHFA financial statement and contact information in the PHFA loan servicing department. So our players here are going to be your primary market. So these are going to be your banks, your savings associations, your credit unions, your housing finance agencies, mortgage brokers, and your mortgage bankers. Then we have our secondary market, which will consist of your financial markets such as Fannie Mae and Freddie Mac, and that's typically where your mortgages are sold shortly after they are made. We have a mortgage originator, the bank or the lending institution that makes the original mortgage to the mortgagor. We have a mortgage holder, who owns the mortgage and has the right to initiate the foreclosure action. We have a mortgage servicer. They are responsible for your customer service, including the collection calls, collecting mortgage payments, managing escrow-related matters, and providing and processing the payoffs. We have our government mortgage guarantors. So for the federal government agencies that insure your mortgages to protect mortgage holders against the risk of default, we have your FHA, your Federal Housing Administration. Your RHSs are your Rural Housing Services, and your VA, which is your Department of Veteran Affairs. So your mortgage loan products, we have the type of mortgages which are conventional, your FHAs, your VAs, and your RHSs. And the loan type will dictate the type of mortgage products available as well as the underwriting and servicing requirements that go with them. So we have a fixed rate mortgage. This is a mortgage loan where the interest rate remains the same throughout the term of the loan. We have an adjustable rate mortgage, which is a mortgage loan that has an interest rate that periodically adjusts based on a variety of indices. We have a hybrid mortgage, which is a combination of a fixed rate and an adjustable rate. We have an option ARMS. This is the pick a pay or pay option, which is typically a mortgage with added flexibility of making one of several repayments monthly. We have a reverse mortgage. This is a mortgage available to homeowners who are 62 years and older and wish to use the equity they have built up in their property already. And the 228 mortgage. So this is a 30-year adjustable rate mortgage that has a fixed interest rate for the first 2 years, and then it's fully adjustable for the remaining 28. The 327 mortgage is the same format. This is a 30-year adjustable rate that has the fixed interest rate for the first 3 years, and then will be fully adjustable for the remaining 27 years. We have an interest-only mortgage. This is a mortgage where the mortgagor only pays interest on the principal balance. A convertible mortgage, this is a mortgage that starts as one mortgage product, which can be either an ARM or a fixed rate mortgage, and then turns into another product. Your balloon mortgage, this is a mortgage which does not fully amortize over the term of the note, thus leaving a balance due at the maturity of the mortgage. So the final payment is called a balloon payment because it grows, and it'll be a large size at the end. This is also a non-conforming loan. And then we have a graduated payment mortgage. This is a flexible mortgage with low initial monthly payments that will gradually increase over a specific time frame. And then your Vendy mortgage. This is a mortgage product offered to purchase VA real estate owned properties. The mortgage is available to both veterans and non-veterans, and the home buyer does not have to be a veteran to qualify for this mortgage. Then you have a jumbo mortgage. This is a mortgage loan in any amount above the conventional conforming loan limit set by Fannie and Freddie. Your buy-down mortgage. So this is a mortgage which enables the buyer to get a lower interest rate by paying a lump sum fee or by paying a fee that is financed over the life of the loan. So there are two types of buy-down mortgages. The first is a temporary, which will lower the interest rate and monthly payments for the first few years. Or you can go with a permanent buy-down, which lowers the interest rate for the entire life of the loan. We have an 80-20. This is often called a piggyback mortgage. So there's two different mortgages made at the same time. The first mortgage is made up of 80% of the purchase price and down payment, and then any amount that is not financed then becomes that second mortgage. We have an 80-10-10 mortgage. This is also another piggyback. The first mortgage is made up of 80% of the purchase price and down payment, and then a second mortgage is made up for 10% of the purchase price. The 103 or 107% mortgage is a mortgage that does not require any upfront cash. This loan covers 100% of the appraisal value and then provides the mortgagor with an additional 3 or 7% in cash. But just keep in mind that this isn't a very common mortgage. And that'll do it for the loan product. So we're going to go into the 3-step process. So the first step is going to be your data gathering. So this is going to be where you do your initial face-to-face meeting with your client. You'll do an intake process. This is where you find out what is the reason for the default or delinquency. What are your client's intentions or goals? What is their loan type? What is the status of their mortgage? Can you get the client to sign a letter of authorization? Or can you get the client to write a letter of circumstance or a hardship letter? Step 2 will be an analysis of the homeowner situation. So this is where you'll discuss the client's affordability, pull their credit report, create a realistic action plan, develop a realistic budget, and then discuss their curable and incurable options. And step 3 will be a development of the Universal Intervention Action Plan, selection of the loss mitigation option for your client, generally dictated by the loan type they have. So if it's FHA, Fannie Mae, etc., you want to find that out and then use your specific calculations or your waterfall to determine their best loss mitigation option. We're going to go gather supporting documentation and then write a cover letter explaining the homeowner situation and include any available cash reserves that they may have on hand. You want to include a copy of the letter of authorization and then send all the supporting information to the lender would be your third step. So we're going to do some strength-based counseling. So with this, you can inspire with praise, empower them with education on the process, explaining the processes to them, identifying all of their options, guiding them through the problem solving, and then you just want to restore their hope and confidence in this process. It is stressful and difficult, and a little bit of hope and confidence will go a long way. So the counselor's role is to assist the client to obtain the best outcome for their circumstances. So to do this, you want to establish and build rapport early on. You want to develop a positive working relationship with your client, explain that your organization works in a solution-oriented way, and look for and acknowledge qualities that the client already has to help them recover. Next, you're going to get clarity on the problem. So you want to ask questions. Why does your client come in today? Are there any time constraints? Identifying deadlines, especially if there's a pending foreclosure sale date already posted. What is the reason for their default? What are the client's goals for their home? What is your homeowner trying to accomplish for their home? Do they want to stay in it or are they ready to sell it? And what options have your client tried and which have been useful for them and which haven't? Next, you're going to practice self-management. You want to set expectations for how you want your counseling session to move forward. So, of course, be non-judgmental and calm and be prepared to go into difficult conversations. You want to be aware of and maintain your professional boundaries. You do not want to provide advice or other services that require a license or a certification. Next, you want to contact the lender or the servicer. This is where you're going to get exact totals on their arrears and the number of months in default. You want to request delays or an extension on their deadlines. Determine if the lender will accept payments or partial payments. And if yes, encourage your client to begin making payments as instructed by the lender or the servicer. And if not, encourage that client to set aside those funds to use when payments are going to be accepted again. Emphasize that these funds should not be used to pay down other debts. Next, we're going to acknowledge the gravity of the situation. So you don't want to dwell on the problem, but say things like, I understand you're going through a difficult time, and I'm here to help you find ways to get through this. We're going to work together to solve problems and make choices. So work with them to encourage your homeowners to tap into their own creativity. Ask them if their goals are actually realistic. Discuss all their available options, including those the homeowner may not want to hear. You want to make recommendations and explain your reasonings for them. And be prepared to say things that may make your homeowner uncomfortable. You do not want to offer promises that they will receive a loan modification, HEMAP loan, etc. And for example, if you are completing a HEMAP summary application, be prepared to explain this to the homeowner and give them options. We're completing this application to give you time to gather your resources. Let's also make a backup plan. Next, you're going to explain the process to the homeowner up front. Explain the foreclosure process in Pennsylvania in a calm and clear manner and give approximate timelines. If you are pursuing workout options, including HEMAP, HAMP loan modifications, etc., explain those processes and their timelines. And once you've determined the course of action, you're going to then begin filling out the necessary paperwork. Make sure you have the client complete the PHFA 3-in-1 authorization form. And if the lender is PHFA, include this with the packet you are submitting. Next, you're going to create a budget for the client using their actual expenses. This is very important. You want to obtain required utility bills, bank statements, etc., and use them in their budget. You want to review their bank statements for expenses such as dining out, alcohol, haircuts, nails, etc., that the client may not mention when you first discuss it. You want to review their pay stubs to determine if the client may have savings that have not been disclosed. Ask the clients if they have IRAs, 401ks, or other saving vehicles that they can tap into for funds to bring their mortgage current. Next, you're going to develop an action plan for your client, but you want to keep in mind that you want to use the PHFA Universal Action Plan because this will have action steps for both you and your client. This will help the client complete a hardship, or you will help the client complete a hardship letter or a letter of circumstance. And the letter should be very specific and detailed for that client situation. Next, you're going to explain what the waterfall is and how it works. And the waterfall is the process a lender uses to determine if a borrower is eligible for assistance with their loan and the type of assistance that they qualify for. If you go to court, in court you want to act as a witness. You do want to provide information about actions you have taken on behalf of the client. For example, I submitted a loan modification packet to the lender on such and such date. You do not want to provide information about what you don't have firsthand knowledge. For example, the client's wife just got a new job. In this case, you could say, I submitted a letter of employment for the client's wife to the lender on such and such a date. You do not want to act as the client's advocate. The client's attorney will act in that capacity. So this is a map or a kind of a diagram, a waterfall, and this will help you determine if they are curable or if their default is not curable. And this is a new chart, so this is one of the newer FHA waterfalls. So this will help you determine their loss mitigation options on here, so you can go through it with them. It's pretty simple. Is the borrower an owner occupant? If yes, keep going. If no, you can see that they will be eligible for informal or formal forbearance. Has the borrower experienced a verified loss of income or an increase in living expenses? If yes, you're going to keep going. No, again, the informal or formal forbearance or foreclosure. If your client is one or more borrowers receiving continuous income, yes, you would keep going. If not, they may be eligible for the special forbearance unemployment. And then, can a mortgage payment at or below the target monthly mortgage payment be achieved by re-amortizing the total outstanding debt for 360 months at the market rate? And then you can see, yes, you can be eligible for FHA HAMP standalone loan modification. Is the borrower's current interest rate at or below market rate? And is the current mortgage payment with reanalyzed escrow at or below the target payment? If yes, again, you may qualify for the partial claim. Can the FHA HAMP combination loan modification and partial claim bring the loan current with a mortgage payment at or below the 40% of the current income? And that may be eligible for the HAMP combination loan modification and partial claim. Is the FHA HAMP combination loan mod and partial claim mortgage payment at or greater than 40% of the current income and one or more borrowers are unemployed? Yes, you go back to a special forbearance unemployment. Has the borrower been determined ineligible for all home retention options, but has income or other assets to repay the indebtedness within 6 months? If yes, they could be eligible for a formal forbearance not to exceed 6 months. Does the borrower meet the requirements to participate in a pre-foreclosure sale? And does the total outstanding debt remain uncurable, and was an attempt made to market the property under the PFS program? And then you can see your options here. So this will be available in Counselor's Corner after we're done. If you guys do want to print these out and use them for visuals, that would probably help you guys. It'd be very useful. Okay, so now we're going to go into our options. So our curable options are your forbearance agreement. So this is an agreement offered by the lender to temporarily suspend or reduce the monthly mortgage payments for a specific period of time. This will have time to improve the homeowner's financial situation and get them back on their feet. This is less damaging to the credit score than a foreclosure, and they can remain in their home and avoid a foreclosure if this is approved. Another curable option is the Fannie Mae Unemployed Forbearance Agreement. This is an agreement offered by a lender to provide forbearance to homeowners whose financial hardship results from unemployment. They may receive up to 6 months of relief. Special consideration is given to homeowners who require 12 months of relief and prohibits the lender from proceeding with a foreclosure during the forbearance period. Another curable option is the Military Forbearance Agreement. So this is an agreement between a homeowner and their lender to temporarily suspend or reduce their monthly mortgage payments during a specific period of time. They may continue for the entire term of the homeowner's active duty and for another 3 months after the homeowner returns. For homeowners who are facing financial hardship due to the injury or the injury of a spouse resulting from being in the military, and what this will do is it will lower or temporarily suspend the monthly mortgage payment for up to 6 months, giving the homeowner time to improve their financial situation and get back on their feet. There is no adverse credit reporting during this forbearance period, and they can remain in their home as well. Another curable is a modification. So this is an agreement between the homeowner and the lender to change the original terms of the mortgage. So this can be the payment amount, this can be the length of the loan, or the interest rate, a rate reduction, or a combination, etc., as long as the payments are affordable. So they may reduce the monthly mortgage payments to a more affordable amount. This will be less damaging to the credit score than a foreclosure, and they can also remain in their property as well. So a curable option for FHA is the Home Affordable Modification Program, or HAMP. The loan is modified to make the monthly mortgage payment no more than 31% of the gross monthly income. The modification permanently changes the original terms of the mortgage. This will resolve the delinquency after a successful completion of the 3-month trial period. They may reduce the monthly mortgage payments to a more affordable amount and will give the homeowner a new start, which is also less damaging to the credit score than being in a foreclosure. Another curable FHA option is the HUD partial claim. So this is an option where HUD advances funds to reinstate the mortgage via a zero-interest loan to the homeowner. This will resolve the delinquency. This can catch them up on past due mortgage payments. The homeowner must execute a promissory note and a subordinate mortgage. The loan is payable at the end of the mortgage if the homeowner refinances or when the homeowner disposes of the property. And it's typically used with a loan modification, but this can also be used without one. So if a homeowner's monthly payment is greater than 31% of that borrower's gross income, the lender may consider a partial claim. So FHA agrees to remove a portion of the borrower's principal so that the borrower's mortgage payment falls below 31% of their gross monthly income. The portion of the loan that was removed from the principal becomes an interest-free loan that the borrower must repay to FHA at the end of the loan, or if the borrower refinances, or if they sell their home. The lender will not receive the removed principal amount from the borrower, so it will make a claim to FHA to recover the amount of the principal that was removed from the loan. This is then called a partial claim because the lender claims reimbursement for only a portion of this principal. So next is a refinance. This is for both FHA and conventional loans. So this is a new loan with either new terms, interest rate, or monthly payment that completely replaces the existing mortgage. Payments are more affordable. There's no negative activity on the credit report. This resolves the delinquency immediately, and they can stay in their home and avoid foreclosure. Just keep in mind, this is not common due to the usual requirement of the 12-month good payment history. We have reverse equity mortgage, which is a curable for both conventional and FHA loan products. So this is a form of equity release available to seniors age 62 or older. It enables eligible homeowners to access a portion of their equity. Homeowners draw the mortgage principal in one of several different ways. So they can do a lump sum, and if this option is chosen, there is no further payout over the life of the loan. They can do monthly payments for a specific time frame. They can do monthly payments for as long as they occupy their home, or they can take out a line of credit. For conventional FHA, there is a repayment plan. So this is an agreement between the homeowner and their lender that lets the homeowner pay the past due amount along with the current mortgage payment over a specific time frame to bring their mortgage current. This can resolve the delinquency, can catch them up on past due mortgage payments, is less damaging to the credit score than a foreclosure, and they can stay in their home and avoid foreclosure as well. So there have been some COVID-19 updates, and here they have a site that you can visit to the CFPB site for all COVID options. And it's updated so frequently, so we didn't put any information in this PowerPoint, but you can visit this website and it always has like your up-to-date COVID-19 updates. So our next curable option is the HEMAP. So the HEMAP is a short-term loan, 24 to 36 months, designed to bring delinquent conventional mortgages current. The mortgager cannot be more than 24 to 36 months and $60,000 delinquent. The mortgage default must result from circumstances beyond the mortgager's control, and counseling agencies are reimbursed at a rate of $75 per hour up to a maximum of 5 hours for completion of this HEMAP application. So if your agencies are interested in doing this HEMAP applications, we do offer detailed HEMAP courses monthly, and you just want to refer to our quarterly training schedule for dates, times, and your registration instructions. Another curable for conventional is your insured conventional mortgage revenue bonds. So each private mortgage insurer, PMI, has their own protocol. This is assessed through the company's online portal, and the PMI is the one that makes the loan modification decision. So loans are not recast at 360 months or 30 years because then it will affect the insurance coverage. And just to keep in mind that we generally follow the Fannie and Freddie GSE guidelines. Another curable option for conventionals are your uninsured conventional MRB loan mods. PHFA generally follows the loan mod protocol followed by the VA. Conventional uninsured loans are not owned by Fannie. So eligibility will be determined using the Freddie Mac primary mortgage market survey plus 25% rounded to the nearest eighth percentage. If the borrower is not eligible, PHFA would use the same process to determine eligibility by extending the loan no more than 10 years. And if the uninsured borrower qualifies for either of the two options, PHFA will require an interior inspection. So you can see here a little note that it's only if the UPB is being increased by the loan mod. Then we will go into our incurable options. So the first one is going to be your straight sale or your regular home sale. A straight sale involves selling the home for an amount that will pay off the mortgage. If the home sells for more than the mortgage amount, the difference between the amount of the sale and the mortgage then belongs to your homeowner. And of course, this will resolve any delinquencies immediately. Another incurable option is your hardship assumption. This is a third party who has qualified for a mortgage loan, accepting liability for an existing debt secured by the mortgage. The homeowner remains liable to their lender until the lender releases the homeowner from their further liability. So this will resolve the delinquencies and also give your client a new start. Next is your short sale or your pre-foreclosure sale. This involves selling the home for less than the balance remaining on the mortgage. So the borrower must make a good faith effort to sell their property with the use of a broker. This will require the approval of the mortgagee. This will eliminate the mortgage debt, pre-approve short payoff, and avoid the negative impact of a foreclosure. Another incurable is your home affordable foreclosure alternative option, also known as HAFA. If the homeowner qualifies for HAFA, the homeowner will go to a traditional short sale. If the home does not sell or the short sale is not approved, the homeowner may be eligible for a deed in lieu of foreclosure. The loan must be owned by Fannie Mae or Freddie Mac. Financial assistance for relocation may be available, and they may be able to get another Fannie Mae mortgage in as little as 2 years. Next, incurable is a deed in lieu of foreclosure. This is a process where the homeowner voluntarily transfers the ownership of their property back to their lender in exchange for release from their mortgage obligations. The borrower must make a good faith effort to sell their home through a broker. This will eliminate the remaining mortgage debt. This will avoid the negative impact of a foreclosure. They may be eligible for relocation assistance in some cases, and they can start repairing their credit sooner than if they went through a foreclosure. Next is your cash for keys, another incurable. This is an agreement between the lender and the homeowner in which the homeowner is given a cash settlement in exchange for vacating the foreclosed home. The lender may make an offer of anywhere from $1,000 to $5,000. This will help the lenders avoid the extremely expensive and time-consuming eviction process, and the homeowner can use this cash to begin their new life. And here we are back to our COVID-19 Q&As. So if you need information for mortgagees and borrowers, we do have information on HUD.gov. And it says that FHA has launched a new consumer-oriented Q&A to help homeowners better understand what loss mitigation options are available to them during this emergency. And it is available in the loss mitigation services on the HUD.gov webpage. And we have some more flyers if you guys want to print these out just to keep them around. And also Fannie Mae. All HFAs, including PHFA, are exempt from the Dodd-Frank and CFPB regulation that states that all delinquent borrowers must have a single point of contact until the loan goes to foreclosure. Just keep in mind that PHFA does attempt to provide this when possible. So we do have our servicing department here at PHFA. We have our bankruptcy department. They monitor and oversee clients throughout the bankruptcy process. And we have an escrow department. They collect and pay taxes and insurance premiums. We have a foreclosure department. They oversee the foreclosure process through the court system. A home retention department. They call borrowers and mail default notices for both conventional and our FHA loans. Our loss mitigation department. They negotiate workout plans and other alternatives to foreclosure for both conventional and FHA loans. And we have our property preservation department. They handle insurance claims, manage vacant properties, damage and vandalism claims. The REO, or the real estate owned department, assumes all responsibilities for ownership of properties after the sheriff's sale. So for loan servicing, to review any account-specific information for a PHFA borrower, PHFA must have an executed counseling service authorization known as a 3-in-1 on file. This can be found on Counselor's Corner under Resources and Forms. Click the Counseling Agency Update Forms, and then the 3-in-1 can be faxed right here to 717-780-3804 to our loan servicing department. And then just some common sense. You never want to instruct a PHFA borrower that they cannot contact PHFA or discourage them from making their mortgage payments. So the PHFA financial statement is a 9-page document that must be used when requesting assistance for a PHFA borrower. The top page will provide instructions for the borrower and the counselor. You do not want to send an incomplete packet. PHFA cannot move forward with an assistance request until all the documentation is submitted. And because of the time restrictions in PA, Act 91, this will not apply to your HEMAP applications. All right, so the second page is going to be your checklist to assure all documentation is enclosed. Here we have section 1A. This will request basic borrower information. So the name, the military status, bankruptcy information, and their dependent information. Section 1B will request information on the borrower assets and income. So bank accounts, stocks and bonds, cash on hand, owned real estate other than the PHFA mortgage property, employer information, and then any other sources of income that they have, such as child support, disability, public assistance, SSI, things like that will come down in the sources. In section 2A, you will provide the co-borrower or their additional borrower information. In section 2B, you'll provide all the co-borrower or additional borrower assets and income, just like you did for first one. And in section 3, you'll request information about the property. So this will be the property address, the client's intentions and occupancy status of the property, the listing information if they are selling, and any required emergency repairs that the house may need. And section 4 will be the monthly living expenses. And then down here, you just want to list all living expenses that are shown on this page. So the monthly living expenses should also be included in section 4. This form doesn't have a miscellaneous section, so don't forget to include the clothing expenses, haircuts, nails, etc. We suggest using the category for gym membership or children's activities, one of those to record those expenses in. You want to enter their monthly debt payments, their credit cards, student loan payments, etc., things like that on their monthly debt. And then summarize the income, living expenses, and total debt payments to determine their net income or loss at the bottom. So section 8 is your hardship affidavit. And here you want to include everything that is appropriate. You want to check off. You want to check when the client expects the hardship to end, and a description of their hardship and how the client expects to resume making their full monthly mortgage payments in the future. The client must also include a signed detailed hardship letter in addition to completing their hardship affidavit. In section 6, the client acknowledges and gives PHFA approval to investigate their financial documentation. It also states that all borrowers must sign a loan modification if approved, and then the application will be signed by all the borrowers included. So for conventional loss mitigation options, PHFA has 4 mortgage insurers that we are responsible for, or 2. Each has stated guidelines and policies that we are subject to and must receive approval for all our loss mitigation requests. So they are through the PHIF, which is the Pennsylvania Housing Insurance Fund, the PMI Mortgage Insurance Company, Mortgage Guarantee Insurance Corporation, and Radian. So for VA loans, PHFA must receive approval from the U.S. Department of Veteran Affairs for loss mitigation requests. And if you're uninsured, this means you're not covered by any mortgage insurer. These would be clients that have paid the 20% down payment. And if you're uninsured, there is more flexibility for loss mitigation options. So PHFA offers all loss mitigation options which are available from each insurer or guarantor. For example, FHA, VA, USDA, or Fannie Mae. And then we have our conventional uninsured loans, which PA will generally follow the VA guidelines as stated previously. So options available if the borrower is not eligible for or does not want a loss mitigation program will be for your straight sales, short sales, or deed in lieu of foreclosures. And if a PHFA loan has been foreclosed on, PHFA may consider offering cash for keys, but just keep in mind that this is rarely offered. So you don't want to lead off with this one. Here is our loan servicing staff. We have the director, who is Kate Newton, and then your conventional team, which would be Kim Ayala, Ellis Cohn, and Rochelle Zimmerman. For FHN loans, our team is Rochelle Zimmerman, Lynn Mickle, Dee Martin, and Brian Good. And just keep in mind, this will be the team to use if your FHA accounts that are 46 days or more past due, and through the time PHFA receives a complete financial packet or until accounts are sent to the attorney for foreclosure. And next, we're going to hit the foreclosure process. So each state in the U.S. handles real estate foreclosures differently. So it's very important to understand each state has their own state-specific procedures, state-specific terms, and different foreclosure timeframes. One of the most important distinctions in a foreclosure process is whether the foreclosure is conducted through the court system, known as judicial, or outside the court system, known as non-judicial. So foreclosure by a judicial state. So judicial foreclosures are permissible in almost every state. And just keep in mind that Pennsylvania here is a judicial foreclosure state. So the biggest benefit for the lender in a judicial foreclosure is that the lender can ask the court to enter a deficiency judgment against the borrower when appropriate. Keep in mind that here at PHFA, we do not do this. Next is a deficiency judgment. So this is an unsecured monetary judgment against the homeowner whose mortgage foreclosure did not produce sufficient funds to pay the underlying promissory note or the loan in full. This will be money owed back to the lender. This can be governed by state law. This can be given in a court order, and the amount can also be negotiated. And here is the timeline for Pennsylvania. So the mortgage payment is due on day 1, and you typically have 15 days. So then your late notice will be sent out on day 16. The collection calls will begin on day 20. There'll be a notice of default on day 30. The property inspection is around day 45. The foreclosure notice will go out on day 90, also known as your Act 91 notice. And then the judicial complaint will be filed on day 120. This will go into negotiations. There'll be a judgment notice of the sheriff's sale. The sheriff's sale 4 to 6 months after filing, and then it will go in front of the judge for the confirmation of sale, and then eventually ends with eviction. So our mortgage foreclosure scams. We have all heard the ads on the radio and seen the signs and flyers. Having trouble with your mortgage? We can help, or you may be eligible for mortgage assistance. These scam artists may advertise on the internet, illustrate their materials with government logos, give their companies official sounding names, and also use scare tactics. PHFA Beware of Scammers flyers are also available on our phfa.org, and here is the website for them. So these scam artists are convincing struggling homeowners to pay fees in return for false promises. They will prey on the desperate and attempt to gain the trust of homeowners who are in financial distress. They are able to identify distressed homeowners through public foreclosure notices in the newspaper and or online and target them with pressure sales tactics, pervasive marketing skills, and exaggerated conversations. So mortgage foreclosure scams continue to sweep the nation. The Consumer Fraud Protection Bureau in 15 states filed lawsuits against 3 companies alleging they scammed more than $19 million in illegal advance fees, promising homeowners to prevent foreclosures and renegotiate troubled mortgages. At the same time, the FTC has then filed 6 lawsuits against scammers in states. We're taking 32 additional actions. So this is a big thing that we don't hear about often, but it is happening. Mortgage foreclosure scams usually fall into one of the following 3 categories. The first is going to be your phantom help. So the scam artist charges very high fees for basic phone calls and paperwork that the homeowner could have done, or they make promises to represent the homeowner, but then never follow through. Next is going to be your bait out or your equity stripping. So this is the scam artist rescuing the homeowner by helping them to get rid of their home. The scam artist tricks the homeowner into surrendering the title to the house by promising that they can stay on as a renter and buy back the house once things have been, quoted, fixed. In the end, the homeowner can't afford to buy back the house, and the scam artist then bleeds the house of most or all of its equity. You want to be aware of other common mortgage foreclosure scams. There is a forensic loan auditor. This is a claim that for any given amount of money, the auditor will determine if the lender processed the mortgage paperwork correctly. However, even if the papers have errors, it will not affect the mortgage payments. Next, you want to be aware of the phony counseling agencies, which the HUD counseling certification was designed to stop this. We have the bankruptcy scheme. So this is a scammer that will request a borrower to provide 5 to 10% interest in their property to assist with their mortgage and then has them sign a deed of trust. The scammer transfers the money to a bankrupt property, then files bankruptcy on behalf of the borrower without them even knowing. So determine if a homeowner was a victim of a scam. Ask them these 2 questions. Were you told you had to pay a fee to obtain counseling services? Or were you guaranteed a loan modification or asked to do any of the following, like sign over title to your property, redirect your mortgage payments, or stop making loan payments? If there were, you can file a complaint online through the Loan Modification Scam Prevention Network. You can call the Pennsylvania Office of Attorney General. You can call Pennsylvania Department of Banking, or you can beware of scammer flyers here at PHFA for more information. If you were scammed by an attorney, you may contact the PA State Bar Association, Federal Trade Commission, or the NeighborWorks Loan Modification Scam Alert campaign for help. Next, we're going to get into bankruptcy. So this is a legal procedure used to assist a person who cannot repay debts owed to creditors. Petitions are filed in federal bankruptcy courts. There is a relief or protection from all creditors known as an automatic stay. This will allow the client some breathing room, and pre-bankruptcy counseling is required. So extensive changes were made to the Chapter 7 bankruptcy. There was a means test, so any client with more than $182.50 in monthly disposable income would face a presumption of abuse, and the clients have to wait 180 days before they can file another Chapter 7 or Chapter 13. So what is a Chapter 7? So this is known as a straight bankruptcy or liquidation. So this would be liquidation of most of their assets to satisfy the creditors. They are allowed to keep certain exempt property but must maintain payments on that property. And this will stay on their credit report for 10 years from the date of filing. And then we have the Chapter 13. So this is known as their reorganization plan or debt consolidation. This will allow the client to develop a plan to repay all or part of their debts, will allow the client to undergo a financial reorganization supervised by bankruptcy courts and the bankruptcy trustee. The client proposes a plan to pay creditors over a 3 to 5 year period, and this will stay on their credit report for 7 years from the date of filing. And just to keep in mind, so one of the biggest points of confusion for some homeowners is that they think that a discharge bankruptcy means that they now own their home free and clear. A bankruptcy may discharge the note they provided to the lender, but it does not go away with a mortgage. So the lender is still permitted to take legal action, including foreclosure, in the event of a default. And this will end out with our resources here. So we have each other, PowerPay, Volunteer Income Tax Assistance, Partnership for Prescription Assistance, United Way 211, Law Help, Knowing Your Options, USA Government Made Easy, Here to Help, Resource for Housing Counseling, and CFPB resources for people affected by COVID. And then we have our FHA loss mitigations, the Q&A on the HUD.gov, and that'll be all your COVID-19 questions and answers as well. We have resources and fact sheets, Fannie Mae, Freddie Mac information there. And then you can also refer to our 401 newsletter for any other important updates, and also our trainings. And that is it for today. Thank you for your time. We welcome your feedback. If you guys have any questions, comments, concerns, just go ahead and send them over to bsantos@phfa.org, and I will address them there. But everybody have a great day, and I look forward to seeing you in the other webinars. Bye, guys.